Good morning and welcome to our webinar entitled Alternative Financing for Micro, Small and Medium-Sized Enterprises in Trinidad and Tobago, Expanding Financial Intermediation to Support Economic Diversification. This is being jointly hosted by the Central Bank of Trinidad and Tobago and the Inter-American Development Bank. My name is Kevin Finch, Manager of the Research Department at the bank, and I'll be guiding you through this morning's proceedings. I want to especially acknowledge our colleagues from the IDB who are joining us this morning. Also, a warm welcome to our specially invited guests from the public and private sectors, as well as representatives from the media. Now, at the bank, we are particularly pleased to co-host this session today, as it represents the culmination of more than a year of research work and is yet another example of successful institutional collaboration between the Central Bank and the IDB. Just over a year ago, we had a similar stakeholder session to discuss our research findings on the macroeconomic implications of digitalization. This paper was part of the background documents used in the formulation of Trinidad and Tobago's National Digital Transformation Strategy, spearheaded by the Ministry of Digital Transformation. As such, we wish to express our thanks to the IDB for their ongoing support and for partnering with the Central Bank to tackle deep-seated structural issues which often inhibit the envisioned transformation of the domestic economy. The objective of the current research project is to evaluate alternative vehicles for financial intermediation and to identify an appropriate mix of financial intermediaries to finance the economic transformation aspirations of Trinidad and Tobago. The focus is squarely on MSMEs, as we acknowledge that small businesses are key to the success of the Economic Diversification Trust. Previous work on MSMEs illustrated that access and cost of finance are perennial barriers to firm survival and growth, as well as engaging in more meaningful value-added activity. With financial intermediation services predominantly bank-based, an examination of other financing modalities was therefore considered important in order to expand the range of financing outcomes available to MSMEs. In this regard, the study seeks to address the following. 1. Can bank-based financial systems effectively facilitate structural transformation? 2. What is the appropriate mix of financial intermediaries to support economic diversification, including the role of the state? 3. What is the spectrum of financial risk posed by alternative financing vehicles, including here fintech instruments? 4. How can financial market development complement traditional vehicles of financial intermediation? And 5. What is the appropriate role of the government in fostering the evolution of financial development? So this morning, you will hear from Mrs. Kateri Duke, who will provide insight into the work undertaken, with a focus on the results of an MSME survey conducted in late 2022. She will be followed by Professor Thorsten Beck, who with his wide experience in both academia and the policy arena, will provide some policy recommendations. The Central Bank's Deputy Governor for Monetary Operations and Policy, Dr. Dorian Noel, will then share some of his thoughts on the policy recommendations advanced. Now, we would also like to hear from you, so we have allotted some time to take your questions before we close the session, and we'll guide you when we reach that stage. However, before we get into the heart of proceedings, I wish to invite Mr. David Rosenblatt, Regional Manager for the Caribbean at the IDB, to provide some opening remarks. David?
Thank you very much. It's really a pleasure to be with all of you this morning. This has been really a unique partnership that we've engaged in with the Central Bank of Trinidad and Tobago. It started with, and I have to congratulate Mr. Finch and his team. It started with a process by which the Central Bank was asking really the tough questions, and that's what really impressed us. And as a result, though, we realized that we were going back and forth on sort of the terms of reference of this work, and we realized we needed the best in the world to help us with this. So that is when we got in touch with Professor Beck, someone who I've known for decades. I've been a consumer of his work. I'm not a financial development specialist, but as a macroeconomist, we know how important this is to long-term growth and to broader economic development. So we reached out to Professor Beck, and fortunately, he was available. So it's really been a rich and stimulating set of work that we've done, And I really would like to congratulate the research department of the Central Bank of Trinidad and Tobago for taking such full advantage of Professor Beck's expertise and producing some really outstanding work. I'll just leave it at that.
Thank you very much, David. So we'll get right into things. I would like to hand you over now to Mrs. Kateri Duke, who will walk you through the presentation on alternative financing. Kateri?
Thank you, Kevin. So good morning, everyone. MSMEs are often referred to as the lifeblood or the backbone of developing economies, but inadequate access to finance has limited them from maximizing their growth potential, generating employment opportunities, and contributing optimally to economic development. Anecdotal evidence suggests that MSMEs, or the number, has ballooned over the last decade, in no small part due to the digital revolution, but also perhaps within the last few years due to the pandemic, as persons sought supplemental income or saw the opportunity in some of the essential services. However, the credit supply from the banking system, which we proxy by loans to unincorporated businesses, has not appeared to move in step. At the end of 2022, the stock of loans to unincorporated businesses was around 2.3% of the total loan portfolio, and it's been consistently under 3% over the last 10 years. Now, is this supply of finance truly adequate for the MSME sector? Are their credit needs being met elsewhere? Or are they seeking external financing and are not able to secure the amounts they desire to grow their businesses? Any shortfall or mismatch between the supply and demand of MSME credit is what we refer to as the MSME finance gap. And it's among the priorities and the mandates of authorities all over the world to narrow this gap so that they can support and optimize MSME's contribution to the economy, supporting economic diversification. There are many avenues by which this gap can be narrowed, but in the context of increasing digitalization and rapid advances in fintech, we're going to be focusing on those outside of the traditional banking sector that offer alternative vehicles for financial intermediation. And the collective term for these vehicles is quite simply alternative financing. It refers to the range of instruments available for funding outside of traditional bank debt, including financial products that have been developed through innovative and predominantly online platforms. But in the context of developing economies, the capital markets are also considered an alternative finance instrument, as it is not a traditionally accessed source of finance. Let's take a look at the global perspective. So in 2017, the International Finance Corporation estimated the MSME finance gap in developing economies by comparing the current volume or that's the supply to potential demand. The difference was a finance gap of around $5.2 trillion US. And although micro enterprises only contributed less than 10% of the gap, that's the 882 billion, their finance gap was considerably higher when compared to the small and medium enterprises. So their gap was 81% versus 56% for the small and medium enterprises. It's also not unexpected that the global MSME finance gap is unevenly distributed across regions. So we see to the chart on the left, the East Asia and Pacific region accounts for about half of the gap, whereas Latin America and the Caribbean accounts for 23%. However, on a proportional basis, so the chart on the right, the Middle East and North Africa region had the highest unmet financing needs, followed by Latin America and the Caribbean. Of course, we're interested in Latin America and the Caribbean, and the MSME finance gap here was estimated as 87% of total demand. So what this means is that just 13% of MSME financing needs were supplied by formal financial institutions. There are many constraints which influence the size of this gap. From the supply side, so the financial institution's perspective, businesses are sometimes perceived as risky. They may have insufficient records, unconvincing loan proposals, inadequate collateral. Credit information systems are often deficient, so that financial institutions, are not able to access the amount of information they need to be able to properly assess the creditworthiness of a borrower. And generally, there's a higher cost of due diligence for a financial institution providing a loan to a micro enterprise or smaller institution as compared to larger loans to larger enterprises. On the demand side, so the business's perspective, it overlaps the supply barriers in some cases. So they believe the cost of borrowing is too high or collateral requirements are too high. And they have limited experience or limited credit history and think the administrative requirements are onerous. And sometimes there's a fear of rejection, so they don't reach out in the first place to access this financing. Alternative finance solutions are able to overcome some of these traditional hurdles by creating credit more accessible to MSMEs. As we discussed in the introduction, many have evolved in the fintech space. And due to the digitalization of their services, fintech companies are often able to have faster loan processing with lower transactional and funding costs. They may accept smaller loan requests, and they may be more willing to consider non-traditional data in their credit risk assessments. There are many forms of alternative financing, but they can be broadly categorized into these three: debt-based, equity-based, and non-investment-based. We won't go through the options in detail, but it's important to note that each has its advantages and disadvantages to both the business and the investor. And of course, this is dependent on your business profile, the stage at which you're at, as well as your risk appetite. So debt-based options include securities, as we mentioned before, the capital markets, peer-to-peer or marketplace lending, balance sheet lending, and invoice trading or factoring. Equity-based options include public equity via specialized platforms, so subsets of stock markets, for example, a junior stock market like we have here in Trinidad and Tobago. Private equity venture capital or angel investing, so think Shark Tank or the local planting seeds, as well as equity-based crowdfunding. Non-investment-based options include reward-based crowdfunding and donation-based crowdfunding. These options, as compared to equity-based, where in return for your investment, you receive shares, these investments, you don't receive any monetary gain. So for reward-based crowdfunding, you might receive the actual product, whereas donation-based, you're simply a donor. Crowd-led microfinance is also included in this category. Now, as part of the research project, the case studies of countries where alternative finance markets have prospered were assessed. Barriers to financing are comparable among developing economies, but efforts towards narrowing the financing gap are at varying stages of development. So the World Bank and Cambridge Center for Alternative Finance in 2019 suggested that regulatory benchmarking may push countries toward the adoption of tailored frameworks for alternative finance activities. In a survey of around 111 jurisdictions, the respondents identified Malaysia, Mexico, and India as the go-to jurisdictions for alternative finance regulation in the respective regions. We also included in our study the case of Jamaica as a supplement to the LAC region, as while 66% of the benchmarking for Mexico was cross-regional, only 34% was intra-regional. And due to time, again, we won't go into the details of these studies, but they are certainly considered and reflected in the recommendations. What I would say, though, is that a review of the country experiences, even with varying degrees of alternative finance adoption, reveals a common element. That is, government support alongside sufficient regulation have been pivotal in encouraging the growth of these markets while safeguarding financial stability. And this echoes the sentiments of the Global Alternative Finance Market Benchmarking Report, which says there seems to be an apparent correlation between alternative finance volume growth and advanced regulatory frameworks aimed at fintech activities. Before we get into the rest of the presentation, I just want to take a moment to highlight the efforts by the government to stimulate activity in the domestic MSME sector with a focus on the non-energy sector. Although application procedures and criteria for accessing these facilities may create some hurdles, they do provide much needed support to MSMEs in the form of financing, training, advisory services, mentorship, and other business development solutions. These allow MSMEs to address some of the barriers they may face. MSMEs can access these facilities from various government institutions, including a number of ministries, Export TT, Exim Bank, NEDCO, and others. So getting into the meat of the matter. The first step in addressing the research problem before we can even think about identifying those alternative finance options, we need to have some measure of the actual gap and understand what factors influence this gap so that we can make some solid recommendations on how we can narrow it. So we issued a survey, we developed it in-house at the central bank with the main objective of quantifying the TT MSME finance gap. But supplementary objectives included identifying the factors which influence credit demand, identifying the sources and uses of funding, as well as gauging awareness and perception of credit sources. The target population for the survey was all MSMEs registered and operating in Trinidad and Tobago, but we applied a non-probability sampling method to get our sample. The survey was developed using Opinio, which is online based, and disseminated through two companies, Plantain Seeds Caribbean and the National Entrepreneurship Development Company, or NEDCO. And I just want to say a special thank you to CEO and founder of Plantain Seeds, Ms. Stephanie Pemberton, and her team, as well as NEDCO CEO, Mr. Calvin Maurice, for enthusiastically supporting our initiative. During the dissemination period, which was about 6 weeks, 257 participants began the survey, but 144 completed all questions. For the purpose of this analysis, firms were classified as large, medium, or small or micro enterprises based on the criteria listed on the slide, which is fairly consistent with the definition provided by the Ministry of Labor. We found that there were 2 large enterprises that completed the survey. So when we extracted these from the sample set, we were left with 142 completed MSME questionnaires. And this is what our analysis is based on. So beginning with the respondent profile, 3 out of 4 of the respondents, or 75%, were micro enterprises. Note that the latest data available for Trinidad and Tobago on the MSME Country Indicators database suggests that around 80% of registered businesses were micro enterprises. So the sample is not too far off from that distribution. Most sole traders were between the ages of 25 and 44 years, and female business owners outnumbered or contributed a greater share than the males, especially for micro enterprises. Respondents were also well educated, with most having post-secondary education. Most firms were also less than 10 years old, but note that about half were between 1 to 5 years old, implying that they were either created in or in their startup phase during the pandemic period. Firms were also concentrated in 6 sectors: food and beverage, professional services, personal care, etc. And this distribution is also fairly reflective of operations on a country level, where the most significant activities are in the services sector, such as retail and distribution and personal services. Also not included on the slide, in a chart at least, goods and services were targeted for the domestic market. So only 13% of firms exported their products, and most of these were micro enterprises. Firms were then asked to identify the platforms that they use to advertise, sell, or receive payments. Most advertised or sold on social media, with over 50% utilizing Facebook, Instagram, or WhatsApp. And a greater percentage of small firms used more traditional advertising platforms, such as company websites, in comparison to the micro firms. Across all firm sizes, cash is king. 96% of businesses accepted cash as a payment method, but this was closely followed by electronic funds transfers, so that's bank transfers, direct deposits, for example. And for the firms that accepted digital wallets, such as PayPal, social media was the primary form of advertising. We were then asked to identify the major growth inhibitors and pointed to lack of financing, cost of financing, and local economic conditions as the top 3 constraints affecting the ability to grow. And we must be mindful of the economic climate within which this survey was issued. Conditions over the last 3 years may be responsible for driving the negative sentiment towards economic conditions and cost of financing, in spite of reduced interest rates and ample liquidity during the period. Businesses may have preferred to prioritize savings in light of pandemic-related lockdowns, supply chain disruptions, and rising inflation. The factors affecting respondents to a lesser extent were competition, high operating costs, and a reduced market for products and services, while the sample was fairly neutral about staff matters. In response to where they sought information on financing, internet-based platforms were the most popular. 65% of firms relied on social media and 58% reviewed provider websites. Looking at the distribution by years in operation, however, we see that social media was preferred by the younger firms, while firms operating over 10 years tended to rely more on traditional advertisements and more other resources such as business conferences. Onto awareness of different financing options. Traditional sources of credit, such as banks and credit unions, were the most well-known sources of credit across all firm sizes and years of operations. 95% of the firms knew about banks, 87% about credit unions, respectively. Government programs and development banks were also popular, particularly among the micro-enterprises. The innovative forms of financing, however, such as the capital markets go down, were less popular. But it is worth noting that around 34% of firms had heard of crowdfunding, while 27% had heard of the capital markets or venture capitalists or angel investors. Sorry about that. I should mention when we analyze this by age, we found that younger firms were more likely to have heard about the more innovative forms of financing that were internet-based, a likely indicator of the platforms through which these types of financiers advertise. Companies were then asked to identify how they would use financing if they received it. So just under 74% of firms indicated that they will invest in capital goods such as vehicle, equipment, and real estate, whereas 69% wanted to increase advertising. 59% in turn would expand production. Closer scrutiny by firm size revealed that small and medium-sized enterprises were slightly more inclined to want to expand their footprint, so open new branches, rather than advertise or expand production. And while there was healthy appetite among all firms to undertake activities that would elevate the business, on average, a micro-enterprise indicated a greater number of potential uses than a small or medium enterprise. When asked preferred financing sources to fund these activities, firms generally preferred externally generated sources of funding, such as grants, loans, and donations. Businesses would also seek more options to fund expansionary activities in comparison to daily operations. And together, this makes sense as formal lines of credit provide greater potential access to the higher amounts required to undertake a business expansion in comparison to running daily operations, which corroborates earlier results, which suggest there's healthy appetite to elevate businesses, though they may recognize that they are limited in their own resources. Those are just the potential uses and sources. But what about actual? When asked about their activity over the last 5 years, 44% of firms indicated that they had not applied for financing, most citing challenges such as onerous requirements, loan affordability, and a complicated application process. Now, this chart is just a frequency distribution of responses, but firms were able to select more than one response. So while we see 30% of the responses with too many requirements, what this actually is 70% of firms. In the same way, 50% of firms found that the loans were too expensive. Conversely now, 56% of persons applied for financing at least once within the last 5 years at an average rate of 3 applications per firm. And there was a higher frequency for firms less than 5 years in operations, so 4 times per firm, than older firms. In total, 148 applications were submitted by 79 firms over the last 5 years, at least once to a particular finance provider. The most popular source was government programs, and there's no surprise there given the sample we issued it, or given the company we issued it through. But subsequently, the distribution of results mirrors the sample's awareness of credit sources. So commercial banks, the second most popular, and credit unions, third. they were the more desirable financing options. There was, however, weak appetite for funding from innovative forms of financing. It was just about 12% of requests. In comparison to respondents' awareness before, we saw 30% new capital markets, 27% venture capitalists, etc. This is quite low. And it suggests that there may be some information asymmetries, making more traditional avenues more attractive. The main reasons firms chose to go to these selected sources of financing are highlighted in the figure on the right. Most companies source financing from providers they had existing relationships with, or those with easy application processes and fewer requirements. If we just look at the alternative finance providers exclusively, why firms went to these firms or businesses, our results show that an existing relationship was the most important factor, followed by fewer requirements, speed of obtaining finance, and ease of applying. And as we mentioned, the majority of respondents applied to government-supported programs, some successful and some didn't apply altogether. Given the number of facilities available, we were interested in finding out why not. So most firms stated that they did not know about the applicable facilities, or they believed support was inaccessible to them. Other reasons included lengthy wait times, not receiving updates on the application, ineligible business ventures, and stringent requirements. However, for the firms that did apply, most found that the government support partially helped their business grow. However, additional financial support was required. When it comes to the value of the applications, most were low value, so less than $100,000, and requested from government programs, commercial banks, and family and friends. These are actual applications we're talking about now, right? MSMEs applied to commercial banks and credit unions for the most high-value applications, 64%, while alternative providers accounted for about 11%. However, around 50% of all applications were outright rejected, no funds received. If we analyze the amount received depending on the financing source, we found that there was little success with the non-traditional providers. So we see all those that series of red bars there. And among the traditional providers, the highest failure rates were within the commercial banks and development banks and government programs. Respondents were also asked to share the reason they were told they were rejected or did not get the full amount. Around 27% said it's because they had insufficient collateral, or 16% the age of the company. But what is even more noteworthy was 19% said that they were not given a reason as to why they did not receive the full amount. So with this detailed information on applications for financing, we were able to estimate the domestic MSME gap. So the top table is the MSME financing requested and received by actual number of applications. And so that we're following 40 of the applications for less than $20,000 did not receive any financing, while 6 of the applications between $50,000 and $100,000 received full financing. Using this data, we want to estimate a dollar value of these applications by percentage requested, and that's calculated in the table below. So following through on the same example, note that the options they had were ranges for the amount requested, right? So we used midpoints of those ranges, with the exception of the first range, where we used a range of $5,000 to $20,000 for a midpoint of $12,500. Multiplying that by 40 applications, we have a dollar value of $500,000 in this range that were not received. In the same way, for the second example, between $50,000 and $100,000, midpoint being $75,000, 75,000 by 6 gives us $450,000 in this range that was received completely or in full. After populating the table in this way, we are able to get the dollar value demanded according to the percentage received, and found that the total estimated demand for the sample was around 18.7 million TT dollars. I'm just repeating this table now on top so we can follow the calculation. Our final step after estimating demand is estimating the gap. we start off where we ended off with the total amount requested by percentage received. Using the minimum and maximum of the percentage received ranges, we then find the minimum and maximum dollar amount received for each band. So let's say within the 26 to 50% range, if the total amount requested was $695,000, this implies a minimum of $180,000, 26% of 695, and a maximum of $347,000, 50% of 695. These sets of figures here are therefore a range of estimates for financing supplied. And recall, of course, the calculation of the gap is the difference between financing supplied and financing demanded. So it's a simple subtraction, and we end up with a range for MSME financing gap. Minimum being $13.9 million, maximum $15.6 million. This is for the sample, but what we want and what we're more interested in is assuming this represents the target population. This implies that between 75% and 84% of finance needs of MSMEs in Trinidad and Tobago are not being fulfilled. If we conduct this exercise by firm type, we found that microenterprises contributed the majority of the gap, while they had a high unmet demand of between 81 and 87%. So what can we take away from the broader findings of the survey? The MSME gap indicates that the credit needs of MSMEs in Trinidad and Tobago are not being adequately met by available options, suggesting there is greater capacity to expand the alternative finance landscape. They're eager to build a capital base. However, there's limited awareness of non-traditional financial providers. And even with that awareness, even fewer have pursued these sources for funding. Education is key. Despite the healthy appetite for financing among MSMEs, demand also remains unsatisfied due to several supply constraints, such as lack of collateral, insufficient company credit history, and inadequate documentation. And finally, if we ask the MSMEs themselves what they think are their greatest constraints to growth, they point out lack and cost of financing as the major growth inhibitors. That said, the greater problem is not the availability and cost of funds. As you mentioned, there are ample excess reserves in the financial system. We're in a period of lower interest rates, and there are several government facilities available dedicated to MSME development. However, the results suggest that there are underlying constraints which appear concentrated in the pre-application phase, such as business proposals, record keeping, etc. And the introduction of alternative finance options has proven successful in several economies to reduce the MSME financing gap by minimizing these common barriers to finance. So in order to shift the composition of MSMEs to higher value activities for sustainable economic diversification, engagement of alternative finance solutions is key. Finally, creating sustainable and meaningful diversification through MSMEs requires a two-pronged approach. One, targeted action to reduce the structural, financial, and non-financial barriers to financing, and then facilitating an environment conducive to expanding the range of alternative finance options available to the sector. And no single organization can shoulder the responsibility of creating a broader financial ecosystem that supports MSME finance and its benefits, but rather each of the government, regulator, other private sector participants, such as credit providers, data collectors, and credit reporting agencies, has its parts to play. And with that, I'll hand you over to Professor Beck to take us through some of the recommendations based on his analysis.
Thank you very much, Kateri. Before we move to Professor Beck, I want to congratulate you again. This was a very extensive piece of work, and Kateri would have spearheaded a lot of the internal work on this. So thanks very much. I've had to re-emphasize some of the main takeaways is that there's a tangential issue to access to finance, which is that of financial education. And we really have to invest significantly in financial education if we are to make any inroads into the MSME gap. Now, in terms of, before we move on to Professor Beck, by means of his bio, Professor Thorsten Beck is Director of the Florence School of Banking and Finance and Professor of Financial Stability at the European University Institute. He is co-chair of the Advisory Scientific Committee of the European Systemic Risk Board and co-editor of the Journal of Banking and Finance. He's a research fellow of the Center for Economic Policy Research and CES-IFO. He was professor of banking and finance at Bayes Business School, formerly CAS, in London between 2013 and 2021. He was also professor of economics from 2008 to 2014 and the founding chair of the European Banking Center from 2008 to 2013 at Tilburg University. Previously, he worked in the research department of the World Bank from 1997 to 2008, and over the past 12 years has worked as a consultant for, among others, the European Central Bank, the Bank of England, the BIS, the IMF, the Inter-American Development Bank, the Asian Development Bank, the European Commission, and the German Development Corporation. In addition to his numerous academic publications in leading economics and finance journals, he has co-authored several policy reports on access to finance, financial systems in Africa, and cross-border banking. He also has research and policy experience across a large number of countries across the world. Professor Beck holds a PhD from the University of Virginia and an MA from the University of Tübingen in Germany. So with that, I'll hand you over to Professor Beck.
Oh, thank you for letting me know. Oh, okay. Well, let me start again. And thank you again for the very kind introduction. And I hope you can see my screen. And now you can hopefully also hear me. I'd also like to add my congratulations to the research department of the Central Bank of Trinidad and Tobago for the overall research program, for the approach, but also for the presentation just given. What I would like to do during the next couple of minutes, I would like to, on the one hand, give a bit of a broader picture. I'm going to comment a little bit on Kitteri's presentation in certain aspects. And then, as already announced, I'm going to give some general policy recommendations. I don't have the time to go into all the details. And unfortunately, I will also not have the time to go into these 5 very pertinent questions that Kevin posed at the beginning. I think that's almost like not even sufficient for a 1-week workshop, even less for a 20 minutes presentation. But I think all of these questions are very, very pertinent and relevant. So let me actually also kind of start on where Kitteri at the previous presentation kind of started. Why is that we care about SMEs? So if you want to, why do we care about MSMEs? Why do we care about small firms? Well, so it's not necessarily the case that having more of them is always better. Yes, easier firm entry and exploiting growth opportunities can provide more competition, can provide innovation. But I think the main reason, and I think that also came out in the previous presentation, is that small, mid-sized enterprises are effectively the private sector of most emerging and developing markets. So it is important to talk about them. And it's important to talk about that how the limited access to finance, the high cost of finance, ultimately prevents them from growing, operating efficiently, and ultimately also from them providing a contribution to society and to economic growth. Now, there is a large body of research, which I won't have the time to go through, that basically shows that, yes, financial sector deepening helps smaller firms more than larger firms. It allows for more entrepreneurship, firm dynamism, and ultimately also innovation, what any economy relies on. It allows firms to really exploit their growth and investment opportunities and grow to the optimal size. And it also actually gives benefits, it gives incentives to become more formal, to kind of move from the informal economy into the formal economy. So there are lots of good things to be said, but there are lots about bad things about to be said about financing constraints, preventing firms to operate efficiently and grow. And there's lots of good things to be said about how financial sector development can contribute through its positive impact on SME development, ultimately to economic growth. The question, of course, is how do we go about this? And I think that is also the very pertinent question that was posed in this research project. And looking at examples of other countries is an excellent starting point as undertaking in this project. Now, first, why is it that SMEs are left out? And there was a very interesting slide already on that in the previous presentation. But let me try to kind of really put it down to two main factors, two very basic factors. One is the cost factor, and I'm looking now from the side of financial service providers, for example, of banks. Why is it that banks are more reluctant to lend to SMEs than they are to large corporates, and they're sometimes even more reluctant to lend to SMEs than to households? And one is, again, the cost factor, because for any financial service provision, there is a fixed cost in there in terms of account management, in terms of evaluation, in terms of monitoring, in terms of enforcement. Given that SMEs have demand for smaller loans, but also given that they're very heterogeneous, it is much harder to kind of benefit or reap economies of scale from SMEs than, for example, from households or for larger enterprises. The second element, also already alluded to, is of course the risk. There is what we economists like to call the information asymmetries between borrower and lender. There's so limited information about SMEs, not necessarily audited account statements, if there are any financial statements in the first place. And of course, there is a heavy reliance on collateral, which again, many SMEs don't have, either because they don't have the formal property rights, or they have movable collateral, which cannot necessarily be used as collateral. And of course, these challenges arise on all levels, bank level, country level. And that's why we often observe, and here Trinidad and Tobago is not alone, that small enterprises are often kind of squeezed in between household credit on the one hand and large enterprise finance. So, and just to give you a little bit more flavor, so you've seen earlier the numbers for comparing across regions of the world. This is out of a paper I did a couple of years ago with Henry Mooney also from the IDB, looking at different Caribbean countries, and this just shows the number, the share of firms that see access to finance as either very severe or as a major obstacle. Interestingly, here actually for Trinidad and Tobago, you can see large firms are actually complaining too. It's not just the smaller firms, but when it comes to the cost, it's actually more the smaller firms that are that state this as a severe, very severe obstacle. Now, also already alluded to is are the reasons why are SMEs being rejected, or why are they being discouraged in the first place? And I think it's important to look at both. It's not just about rejection rates, but it's also about why is that firms don't approach banks in the first place or other lenders. There is, of course, the affordability, the high interest rates, which might point to macroeconomic problems. There might be the very burdensome application processes. There might be also social barriers to entering a branch. There might be already, what I already mentioned, the lack of the necessary collateral. There might be other documentation requirements, a formal license, for example, or a formal property title, which they might not necessarily have. Of course, there's also a lack of trust sometimes. That's especially in countries with a history of banking crisis. So all of these reasons, and I think it's important to not just look at where firms apply, where they get loan, if they get loans, but also why they do not apply. And these reasons, actually looking at these reasons, can also give some kind of hint about what is missing in the underlying institutional framework. Now, I put two other reasons here a little bit apart, and that's already when Kateri talked about the financing gap. She alluded to this. Of course, it might also not be the necessary amount. It might be less than what they had asked for, which then prevents them from actually undertaking the investment they wanted to do in the first place, or it might not be the right maturity. It might be a short-term loan, which is more difficult to use, of course, for long-term investment projects. Now, it's always important to also look at firms that do not need funding. So there might be firms that actually don't have demand, either because they have enough internal cash, or because they don't see any, or they don't see any expansion options or expansion possibilities, or alternatively also because they might not know about different funding options or possibilities, which is something that also Kevin already referred to earlier as kind of a literacy problem. So also very important to keep in mind. So, but as you can already see, and I'm very grateful for Kateri for presenting these different data, is one really has to look at it from this problem from many different sides. So it's not just about a headline indicator. It is, and that's important as well to attract attention, but to really drill deeper and kind of understand of why is there an SME financing constraint, a SME financing gap. It is really to understand the reasons of what prevents SMEs from applying and what prevents them from actually obtaining loans. And from there, we can then map it into certain policy options. So now, who finances SMEs and how? So we heard already about this in the case of Trinidad and Tobago. If you look at the broader cross-country picture, so it is, yes, if it's about external funding, it is mostly about bank credit. That's traditionally the most important source. In addition, of course, to internal cash flow, owner resources, retained earnings, or trade credits, supplier credits, meaning short-term credit for 90 days that they can receive from their suppliers. Which, of course, again, it's not an ideal way to invest, because for 90 days you won't get the return on investment project. It's already shown also in the previous presentation, there's very limited access to capital market. I mean, if you think about, again, the MSMEs, and I don't have the slide on that, but MSMEs is a very broad group of firms. I mean, you have everything from enterprises, a small car garage, a repair shop with 1 or 2 employees, over smaller enterprises that maybe produce processed food, over to a mid-sized enterprise that maybe exports. And of course, all of these have somewhat different financing patterns, but also certain different financing needs. And I would say that in terms of access to capital markets or to public capital markets, it is really about mid-sized enterprises with growth possibilities that would qualify for that. I have to say, I think it's for smaller economies such as Trinidad and Tobago, it is very difficult to develop a kind of a junior tranche in the capital markets. So it is something I know that also when I was still in the IFI community that we've always kind of tried to push, but I think it's one has to be also very realistic in what one can achieve by developing public capital markets. And maybe, as already done in the previous presentation, look at alternative financing forms. And here, actually, I'd also like to point to, for example, equity fund venture capitalists. Again, these are not for micro, maybe not even small enterprises, but again, as an option for mid-sized enterprises might be certainly possible. Now, very briefly about bank lending. We typically, as economists, we know especially if you work with data, we'd like to classify things. And of course, the world is not white and black. It's lots of shades of gray. But we typically like to distinguish between what is called the relationship lending and the transaction-based lending. And again, relationship lending is also one of the reasons why SME finance is so expensive for banks to do, because it relies on personal interaction, on personal repeated interaction between loan officer, branch manager on the one side, and the entrepreneur on the other side. Transaction-based lending, that is actually where economies of scale might fit in, might actually come in. For example, leasing, factoring, where you rely on data, hard data, or hard assets on collateral, such as the leased asset, or on invoices to a larger buyer, for example, as collateral, and these are typically also then more cost-effective. But we typically also observe that different types of financial institutions, different types of banks undertake different types of, use different types of lending techniques. It's typically the smaller, the local banks that use relationship lending. Larger institutions, foreign banks, for example, use more transaction-based lending. And it's certainly also an option, though there are also certain downsides, which I'm happy to elaborate on later. So let me maybe then briefly talk about financing gap, because this was also, and I was very impressed by these, by both the survey undertaken and by the way then there was the numbers were derived, and then also again, I think it's important to have these kind of headlight indicators to draw attention to the problem. Again, when we drill deeper, again, I would like to see a bit more. I would like to recommend that it's really important to look at all from all the different sides of the problem. Now, what we've seen here, what Kateri presented very ably, was the kind of a survey-based measure of the financing gap, which basically says, well, we know how much they demand, we know how much they got, and we can kind of look at the difference. Now, there is obviously a certain subjective element in there, because you focus on what the firms say. They might often know it, of course they know what they want. Of course, the question is, does this specific sample, can you extrapolate to the larger population of the SMEs? And as important, is it actually also bankable demand? And I think here we have to, and again, I don't think there's an obvious answer to that, but there might also be demand for which is not commercially viable in the first place. So that's a bit of a downside, and which then might also push these numbers to be a bit overstated. I'm not saying they're wrong, but they might be a bit overstated. Another way to go about it is say, well, let's look at what unconstrained firms actually use in terms of external funding, and then extrapolate from these benchmark to actually compare to the actually observed funding of firms. This would then rely more on balance sheet rather than on financial statements rather than on survey data. Of course, again, we have to make lots of assumptions about that in terms of is there the same demand for benchmark as for the other firms? And it's not as easy to take firm-specific factors into account. Interestingly, so I did recently a study for the EU on that. There is not a very high correlation between these two ways of calculating the financing gap, which doesn't mean that either of them is wrong. It's just, I think they measure very different things. So the first one is more constraint based. The other one is more kind of pure quantity based. And again, none of this actually takes even into account the other constraints already mentioned, such as the interest rates or the maturity or collateral requirements. So very briefly on digitalization, which I think, and I'm actually a big believer in digitalization and in the benefits, also in the risks. Just to get this first thing out of the way, crypto, decentralized finance, I mean, for me, this is the tulip mania of the 21st century. I would just ignore this stuff, or if not, try to regulate it in a way that it doesn't do any damage. I don't think there's any real economic benefit from the whole crypto world. But then going to more serious forms of alternative finance, lending platforms, for example, and Kateri also discussed some of these different forms, which basically links investors directly to borrowers, where the platform is kind of doesn't use its balance sheet, but uses its platform to provide matching and information services. At least that's a theory. In Europe and US, what we've seen now that the investors have turned mostly institutional. There are very few actually platforms that rely primarily on individual investors. The country where these lending platforms have kind of gone full cycle is actually China, where there was a huge boom and then also a huge bust and regulatory crackdown. Actually, most of it wasn't necessarily used for firms, but actually also, again, for mortgages, kind of trying to circumvent borrower-based macroprudential measures. Again, I think there is, the jury is still out. I think this can be a useful contribution. It is, of course, important for investors to know what they kind of get into, and it's also important for the borrowers to know what they get into when they tap this kind of funding. I think more generally, fintech companies can provide important competitive pressure on incumbent banking system. Again, there is this trade-off between encouraging competition, encouraging innovation. Innovation also in the sense that these new fintech companies use additional new data sources, such as what we call big data, but also AI, machine learning, artificial intelligence, machine learning technologies to really reduce these information asymmetries. So that's the positive side. There is, of course, also a risk side, and I think that has to be carefully balanced. Finally, we've seen a lot of these so-called big tech companies. So Mercado Libre is, I'm not sure whether this exists in the Caribbean, but in the continent, Latin America, it's very prominent by now. Of course, we have Facebook, PayPal, and so on, which have moved into payments, but also increasingly into lending services. Again, there's a lot more to be said about, which I don't necessarily have the time to. Again, this is a fascinating area, and I think there's a lot to be learned from other countries. It's important to see what fits best for the local circumstances, and also to see what kind of regulation is being applied to these new providers, both reaping the benefits but also minimizing any potential risks. Let me very briefly talk about the role of government in the remaining few minutes, 4 minutes that I have. And when we talk about the role of government in finance, it is a very prominent one. That's number one. And it starts here. I'm putting a couple of roles for the government, and I want to very briefly walk through. The first one is almost an obvious one, which is the macroeconomic stability. Of course, we like to talk about monetary policy. Of course, there's also fiscal policy. There's also exchange rate policy. All of this plays in here, and I think there's little debate on the importance of that. There's also very little debate on the role of institutions building, of providing the necessary institutional infrastructure for financial service provision. Again, this ranges from rule of law, accounting standards, efficient court system that also you can enforce contracts, and then to credit registry, credit bureaus, which I will come back later. There is the role of regulating financial markets. And again, that's again an important role, because we know that only stable and sustainable financial systems can support the real economy. There might be, again, as alluded to previously, there might be a certain trade-off. Competition doesn't mean necessarily stability or instability. It really depends on how you go about regulating it. Having new providers can bring counterstability and competition, and again, but it's again also to look at the potential downsides if either of them grow too big, for example, or there is a certain boom period, or there's a certain focus which then can go the wrong way if, for example, with a certain shock, or if the cycle turns around. So, but again, regulation, I think, is also with respect to alternative finance modes is really critical. Now, there is a fourth element which I want to very briefly talk about, which is providing financial services. So basically, the government as an owner of banks, of both commercial and the development banks. There is, when it comes to, let me start with the positive point here. When it comes to deposit taking, to providing payment services, there is a mixed evidence on that. So it can be very positive. I mean, we know from Postal Savings Bank that they can have play an important role. Small local savings bank in Germany played an important role in the late 19th century. So yes, there can be an important role. When it comes to the lending side, the experience across the world is mostly negative. Not exclusively, there are positive examples, but when it comes to retail lending, meaning or government-owned commercial or development banks lending to individual firms, I'm not talking about projects, I'm not talking about infrastructure, but really individual firms or even retail customers, typically it doesn't go necessarily well. There's a limited additionality. It's often not very sustainable, financially sustainable, partly because there's a subsidy element in there, or there's not a proper risk management. There might be political interference in the run-up to elections. So overall, the experience hasn't been as positive in this area. Where it has been more positive, but where it's also an area where we have to learn much more, and then this is actually kind of where I want to kind of almost close on, is this using government intervention, for example, development finance institutions, to overcome market friction and failures, which loom very large in the financial sector. Rather than doing retail, doing wholesale, what is sometimes also referred to as second tier DFIs, for example, subsidizing fixed costs, guarantee scheme, business to scored scheme, maybe also grant schemes for new entrepreneurs. So there's a lot of variety of different options which have been tried across the world, including in Latin America, that might be very positive, and where, again, government institutions can actually play a very important role. Important is, of course, additionality. We want to enter where the market doesn't provide. We don't want to replace the market. And of course, also it has to be sustainable to for a certain extent. Finally, let me come to my last two slides. Policy conclusion, more general. So number one, finance is one of the most institution-sensitive sectors in the economy. So again, that's why we talked earlier about rule of law, macroeconomics, and so on. Market-based provision has clear advantages, but we do have market failures, and we have to know how to address them, including through a positive role of the government. Again, the devil is really in the detail in terms of governance, in terms of sunset clauses for government interventions, for example, through DFIs. Now, let me very last briefly go to some of the recommendations that I got both out of the reading the reports that were produced, but also actually out of the earlier study that I did with Henry Mooney. So, for example, and again, I'm happy to be corrected on any of this here because, again, I don't consider myself an expert on Trinidad and Tobago. Creating a credit registry at the central bank, in addition to the existing credit bureau, might actually help reduce information asymmetries between borrowers and lenders. Creating a movable collateral registry can help broaden the array of assets being available to be used as collateral by firms. Improving awareness and information about financing options is certainly a very important component. I mentioned already the cautious regulatory approach to alternative finance providers. I think, and Katerina also referred to this, there is an array of different support programs already in place by different players, different government players primarily. I think it's important to evaluate them and maybe also rationalize them to really focus on where the support is needed most. And then finally, and of course, any good researcher, any good consultant always says you should do more studies. So I'm apologize in advance for giving this recommendation. But collecting data on SMEs and their financing condition on a regular level, is, I think, something highly to be recommended because it allows also a picture over time on how financing constraints evolve and maybe also what kind of policy intervention can be actually useful going forward. And with this, let me stop and thank you very much for your attention.
Beck, at the end there you emphasize the role of the state, and I would say that as a companion paper we do have some work on the role of the state in terms of government supported programs and the whole issue of financial inclusion in general. So to respond to what we have heard this morning, before we segue into the question and answers, we have here our Deputy Governor, Dr. Dorian Noel, who's going to give us some of his thoughts on what has been shared this morning. So over to you, Dr. Noel.
Right, thanks, Kevin. I just want to say good morning to all the audience who joined us this morning for this important session. I would also like to take this opportunity to give my sincere appreciation to the IDB for collaborating with the Central Bank. And they have done it over the years. And this relationship, research relationship, have been very critical in doing important work for us in Trinidad to understand our domestic circumstances. And the work that we are discussing this morning focus on a very important sector, the SME sector. And if we believe in the statistics that was presented this morning, and it's there in the academic literature as well, that in the emerging markets, the SME sector contributes about 35% of GDP. And globally in advanced countries, it's between 40 and 60%. So the SME sector is important to the economic growth as well as employment. And in Trinidad, there's no difference. The evidence is there. They provided the evidence in the survey results. The Ministry of Labor have provided various statistics on these things, so we understand the importance of the SME sector. But there is the problem. The problem, there is a market failure. SME need financing in order to grow, in order to pay operating expenses on a day-to-day basis, in order to invest in plant and equipment, to generate these GDP contributions to both on employment as well as GDP. And the question is, what is causing this market failure? And how what policy measures we need to put in place to treat with this market failure. And I think globally, all governments, through their policies over the years, have recognized the failure in getting access to SMEs. And they have put in a number of policies as well as infrastructure in place to get access, increasing both the pool and ensuring that SMEs get access to financing. So more or less that is the objective of the exercise and what was presented this morning. I would also like to thank the presenters, Professor Beck and Kateri, for an excellent presentation. I have given my opening remarks. Now let's see what I could find to say to so at least I could take the 10 minutes that was allocated to me. The first thing we thought I would focus on some of the interesting findings in the research. And then I will close off with the recommendation and add a few thoughts on where we go with regards to alternative financing, that space in the domestic setting. The survey provides the review from the SMEs, why they're not getting access to financing. And some of the reasons put forward, the explanation put forward by SMEs are there in the literature. So those explanations and those reasons are consistent wherever we are in the globe, seem to be very similar, nothing different. There's a financing gap, there's need to be closed, and these are the reasons why they're not getting access to finances or the amount of financing they need for the business. I think what is also important, just for the completeness of the exercise, for us to get a better understanding of the domestic setting, is to hear the views of the providers of financing. And that is important. Why perhaps the available financings are there, sufficient amount to maybe to fund the entire SME sector. But because of market fictions, because of information asymmetry, perhaps the type of strategies that these lenders are following, they can't allocate those funds to the SME sectors. And I think important in doing that survey on the providers of funding is to do several things. One is to get the type of funders available there across the alternative space as well as traditional space. We already know about bank credit, etc. And lending in Trinidad is still a bank-based business. But in terms of the alternative space, the type of investors, the available pool that they have at their disposal to allocate, what are the investment strategies that is targeted, what are the target sectors, etc. That is important. And then also to hear from them why SMEs or the rejecting SMEs in such large numbers. That will complete the exercise and give us a fuller picture for both the demand and supply side. Let me turn into some of the interesting findings of the survey itself. One, Kateri mentioned that the survey, 98% is micro and small businesses. And out of that pool, 75% is micro enterprises, which is consistent with more or less the country level. And one of the questions that need to be asked, given that a sizable portion of the sample of SMEs in Trinidad, micro and SMEs companies, 98% is in the micro and small space. We need to ask, and it's a natural question one will ask, whether the creation of these business, and when we look at the age of these business in the 1 to 5 year brackets, whether the creation of these business is just to replace monthly salaries or means of financing families. And if that's the case, the dynamics, the discussion with regards to the type of financing that they are accessing, that give a whole new dimension to the issue of market failures. Perhaps these created business and these owners of these business is not their intention for it to become a global business. like the Amazon and the Microsoft, etc., was just to pay monthly salaries. And in that might explain why there is a lack of information that is created to provide to lenders, etc. And we have to take into account that possibility of that dynamics into the discussion with regards to why they're not accessing financing. Perhaps because of the micro and small space, they might need grants and engine for financing. So we can look at the entire financing spectrum. And that leads me into our next point. In the survey and in the discussion this morning, we treat financing for SMEs as homogeneous, as one single pool. But we need to look at it at a much more disaggregate level. Given the stage of development of the business, and given that a lot is in 1 to 5 years, they might need grants, engine financing, etc. And as larger firms, different types of financing, we just cannot treat the spectrum of financing for SMEs as homogeneous. We need to recognize the stage of development, and at certain stage, they require certain types of financing. In the growth stage, they might require private equity. They might look at debt. They might look at public equity. But we need to factor in that into the discussion, especially given the survey that indicates 98% is micro and small enterprises. And because 98% is micro and small business, they mightn't be able to access the full spectrum of types of financing available. And that is the point that I should make. All right. An interesting thing, and I think that we need, when we look at the policy, or we formulate policy going forward, I think we need to recognize in that policy formulation gender. We need to have a gender policy. Because the survey results indicate, I think, I have the numbers here, a sizable portion of the micro companies survey is being led by females. And we need to ask a question whether, and in Trinidad, when we look at the demographics, it's becoming pretty obvious in terms of numbers that females are becoming the head of household. As a large proportion of females are the head of households. So most likely these micro enterprises that is headed by females might fall in the vulnerable groups. So we need to recognize gender policy. They might be created to provide income, provide additional income to support family, also the family members, etc. And they might be in the vulnerable group. So we need to recognize gender policy in any sort of policy formulation going forward. I return to, let me conclude by looking at the recommendations. I think the first two recommendations presented on the public credit registry, as well as the movable collateral registry. I think that had been in the public domain in Trinidad and Tobago for a number of years. So I fully support those initiatives to create those policies, as well as the necessary legal and regulatory framework around those two mechanisms. I think it will help, definitely helps to reduce the asymmetry in the markets and help to improve financing to SMEs. The improved awareness of information and to SMEs, the awareness and information about financing options to SMEs. I think in last year, the government, Ministry of Finance, the Trinidad and Tobago Stock Exchange, as well as the Central Bank collaborated on launching a SME marketplace. And that SME marketplace, the objective of that platform was to consolidate as far as possible all information that is needed by SME to grow the business, from financing options available on the islands and by the institutions, as well as all the advisory services and training services. All of that was put together in one platform we call the SME Marketplace. is linked off the Ministry of Finance website, so you could actually go there and see what information SMEs could actually log into this single portal and see what information are available. It's important that we continue to update that website. I haven't looked at the performance of the SME marketplace since it was launched in last year, November. But from initial feedback is that they have been getting hits on the website, and they are looking to expand to incorporate other entities on the platform to make all information available to SME in a single portal. So the SME marketplace is some of the initiative with respect to this has been done. And I think what the business sector, business chamber in Trinidad has to do is to further enhance that by bringing awareness and understanding of the different types of financial instruments to SMEs. But the single marketplace is there, and that was an initiative launched again between the Central Bank, the Ministry of Finance, and the Trinidad and Tobago Stock Exchange. In launching that, we also collaborated on enhancing the SME market, equity markets, giving SME the opportunities to access equity financing, to list on the Trinidad and Tobago Stock Exchange on that SME equity platform. The government, Ministry of Finance, has given tax incentive for 10 years. The first 5 years, if you are qualified and you list, you're entitled to 100% tax benefits written off on all taxes, and for the next 5-year period, 50% of all taxes. To go with that SME market, in order to be qualified to list, you need to have a mentor. So that program also launched a mentorship program, and that is there. And the whole objective, we understand, SMEs is having problem accessing financing, and one of the things is that business, lack of information, they don't know how to compile financial statement, governance issue, formulation of business plans, understanding the market in which they operate. And because of that, we thought it was wise to attach a mentorship program to go with that listing on the SME market. So something has been done, and it's that mentorship as well as the SME equity market is nothing new. It has been used in other jurisdictions, etc., and we are applying this in Trinidad and Tobago. With respect to alternative financing, the interesting thing, the people talks about alternative financing, but they didn't go quite into the different types of alternative financing, right? They only touch on one issue, on the issue of fintechs. But we have the private equity space, which is a very broad space globally. A lot of funds are available, and in the Caribbean, the private equity space has been growing pretty well over the last couple of years, where there are a number of private equity funds raising up to $200 million US to fund investment in SMEs and particular sector. I'm certain in Trinidad, that is, I have been talking to those firms who is looking into that space over the last, I could say the last couple of months. And they are saying that funding is available in the private equity space. But the problem is not getting deals coming through. And deals has to do with the quality of the SMEs. And quality of the SMEs has to do with, having information available to discuss the business, provide information projection to private equity financiers. I've noticed in the survey that SMEs going to equity financing, who was 100% rejected, perhaps is a sector that the private equity is looking into, and perhaps the whole issue of information, lack of information, etc. But the private equity space is an interesting space to look at in Trinidad and Tobago. But the people didn't go quite into the depth of these things, and I think it's important for us to survey across the financing space of in Trinidad to get a sense of what is there in terms of availability, the type, and the sectors that is targeting to fund, etc. That's, as I indicated up front, that complete the entire picture from both the demand and supply side. Improving data on SMEs and the financing conditions. I think We talk a lot about information asymmetry, so I'm not going to say much into that. I think that access to financing comes with it the ability to produce quality data and giving lenders access to those data unrestricted. And some SMEs in Trinidad have fallen short on those requirements, in addition to governance issues, etc. I totally endorse the last recommendation. I think this survey instrument has to be become part of perhaps the central bank research activities. We have to do it a bit more often. Definitely in order to evaluate our policy implemented over the years to support SMEs financing and support their growth is performing, as well as to continue to understand how the financing market for SMEs is evolving, because the financing needs, financing types of investors and what they are focusing on in terms of their strategic asset allocation is likely to change ever so often. We need to be aware of those changes taking place in the financing SME sector, as well as the financing options or availability of the types of financing options available to SMEs. I think, and because of that, I will support the this survey done a lot more often. I think we have the central bank done a survey in 1996, and then we did one in 2003, and now we are doing one in 2023. Just to close off, it'd be interesting to see from the 1996 survey, 2003 survey, and now if we could do a tracer survey to see those firms that we surveyed in 1996 and 2003, where they are today, whether they're still in existence. Because this survey in 2023 that was done indicate that a majority of the business is 1 to 5 years old. And again, I make the point that perhaps these are created because to replace monthly salary and to support family expenses, etc., and not to become a global business. I think, and the reason why to do that tracer study, we need to see whether there has been some sort of transition out from micro, small, medium to large. And if there are a sizable portion, perhaps, highlighting those success stories will be able to allow to reduce the uncertainty with lenders with regards to the success of these SMEs. And I think when private equity get into the space, they always like to look at success story, because if the sector, across the sector, there are 1 or 2 success story to highlight, it gives them confidence that there are opportunities to be had and good risk-adjusted returns. And I'm certain that Facebook, Amazon, and Microsoft, when they started off as those micro enterprises, etc. And now they are used as poster companies of what is possible for investors if you get in early. And that is important. That tracer study is very important to highlight those things and bring that information available to lenders for them to get some sort of assurance that they are growth and they are companies that are achieving success. That will reduce. And I will close off. I'd just like to close off by again thanking the presenters, Professor Beck and Kateri, for an excellent presentation, and thanking the IDB for partnering with the Central Bank on this important piece of work. Thank you, and good morning to everyone.
Thank you very much, Dr. Noel, for your insights. In the remaining time that we have, we want to take some questions from the attendees. So if you do have a question, we'll invite you to please raise your hand. When I call you, if you could please state your name and which institution you represent. So the floor is open for questions. Angela Henry Small.
Right.
We're hearing you.
Right. I'm sorry. Right. Just a couple of comments which may feed into questions. One is that in this new world where there are so many non-traditional sources of financing, etc., we probably should not forget, although it may seem like a long way in the future, we shouldn't forget initial coin offerings. Quite a few businesses with a good reputation pursuing that means of financing. So that's one. Secondly, I put a comment in the chat that credit ratings for small and medium enterprises and micro enterprises should probably be the way to go, so that companies can put themselves out there and attract the kind of financing that they need. The big three, that would be Standard & Poor's, etc. This falls outside their purview. So a regional credit rating agency should probably exploit that niche there for the rising. There should be a rising demand for credit ratings for these small and medium enterprises. Caracas comes to mind, but there are a couple of rating agencies in Latin America that are also trying to take up that slack. And then thirdly, there's the rise of big techs like Amazon, Facebook, Netflix, etc., who traditionally were not into financing, but because of their huge customer base, they've started to leverage that customer base into providing financial services as well. So that's another item to keep our eyes on. And so that's it. Those were comments from me. And my question, I suppose, would be, is there any comment on these ideas from the panel? Thank you.
Thank you very much, Angela. Any further questions or comments? Mr. Awai?
Yeah, sorry. Good morning, everyone. I just want to highlight the importance. I mean, it was kind of alluded to in several parts of the presentations and in Dorian's responses about the education of the actual SME principles. I've done some mentoring with Dr. Jack and other people in the past, and a lot of the small business owners that end up starting these businesses and taking that risk, which have to be applauded, invariably they don't have the expertise. So you might have a nutritionist, you might have somebody who's a botanist, somebody who has some area of specific expertise, but they don't have the team. Neither can they afford to attract the quality of people that need to be there to build out. So all of what we're talking here and all the ideas of all the support network has to really have that ecosystem well structured to support the whole development of those SMEs. I know the good work that people like Arthur Lokjak have done to develop that SME program to help build some of that muscle that a lot of these small businessmen don't have. So there's a need also in there for providing that sort of grant funding, another type of financing to help those persons build that capabilities and how to be sustainable and to allow them to grow in a way that will make sense for us to finance them. The other last point I will make is, I know years ago it was tried, and you all mentioned about the need for financials and these things, is making these things mandatory in terms of how businesses operate. Banks are creatures of numbers. In a large sense, we like to focus a lot now more and more on the business model and making sure that you have that team in place and that you have a business that is sustainable. But the numbers help us to be able to arrive at those conclusions to a large extent. And making it mandatory to some extent. So on the one hand, it's us playing our role. The other part is probably the accountants. Many people do say that, the accounting fees are expensive and therefore they avoid going and getting their accounts audited properly. We have the challenge, and I'm not going to say it in this forum, but of trusting the numbers. So making these things mandatory in a sense does in fact create that supports that ecosystem. It's one of the key legs of the stool, in my opinion, in making sure that we can move faster. I can't find how do you finance somebody that doesn't have at least a review of the operations? When I ask people, tell me your numbers, and you don't know your numbers, it's a glaring risk for us. We are fiduciaries. So it's not just about the lending element, it's about ensuring that we lend it in a manner that will ensure we can get by the principal and pay the promised interest to our investors. So just some additional comments for consideration. I came in late, so I'm not sure if many of these were already discussed in the presentation. My apologies. But for the parts that I did hear, well done. I enjoyed the last part today. So good job. Thanks very much.
Thank you very much, Mr. Awai. We perhaps have time to squeeze in one more question or comment, if we do have one, before I turn over to the panelists. Well, I'm not seeing any further questions, so let me open it up to the panelists to react to the interventions this morning by our participants, and anyone could jump in, either Thorsten, Kateri, Dr. Noel, any reactions to what was just raised?
Kateri first.
Sure, I'd just like to comment on Angela's comment about the rise of big techs, which is interesting because in our research, they pointed out Amazon sales as one of the non-traditional sources of finance and information. So actually, they are really capitalizing on that opportunity and recognizing where they can target these businesses by collecting that data, making it easier for those businesses to access finance through them. So it's interesting that you mentioned the likes of Amazon and Facebook. Very much consistent with what we see globally.
Thorsten?
Yes, well, thank you very much for these comments. On ICOs, I mean, as I mentioned in my presentation, I'm very skeptical. I mean, there might be some that actually use it for, there might be some positive examples, but overall, I'm rather skeptical of this whole crypto world. Credit rating, yes. Again, this is probably something more for the upper end of small and maybe mid-sized companies, and but maybe this is also an area where support can be given. I mean, I would not advocate that this is done by a government institution, but maybe a support of a private institution to come up with such credit rating might actually be something feasible. On the big techs, yeah. So I kind of alluded to this a little bit in my presentation, but yes, they have become more and more aggressive in terms of not just offering payment services, but also lending services. Now, the one country where there has been most of the experiences, again, China, where the big two big techs, platform companies, Tencent and Alibaba, have gone into financial service provision through subsidiaries. Again, it can be something very positive because, again, they rely on data that is not available to others. The data that they collect through their platform services, they can use, again, economies of scale, of scope, of the AI, ML technologies to actually take very informed lending decisions. There are also certain risks or challenges associated with that, such as, for example, concentration risk. I mean, typically there are very few of these big techs. They have these enormous economies, network externalities, or economies of network economies, and therefore you typically end up with very few, and that of course creates their own new types of risks. What we've seen more in the US is big techs working with banks, meaning that yes, they might use their data, they might use their network, but ultimately the underwriting is done actually through a bank, because big techs might not be necessarily interested in actually getting a banking license, which they might have to do if they want to really go into full financial service provision. Again, I think is a space to be watched, definitely. On the comment on the education, yes, I think this is a big issue. I guess the one additional point I want to mention here again is we really have to differentiate, and I think also the Deputy Governor made this distinction as well. We have to really differentiate between different types of MSMEs, right? So the electrician, the car repair shop, yes, they might simply not have the scale or they don't have the capacity skills, and they don't have the scale to hire an intern, in-house accountant to help them, basically. So then the question is, how can they go about actually getting this help? And again, allowing for maybe such support firms, again, can be also private sector, maybe with a bit of a helping hand from the government, might actually be very, very useful. In terms of making financial statements compulsory, again, this is a very attractive idea. I guess the only thing I would warn against of imposing too many burdensome conditions again on especially smaller and micro enterprises, because that actually might drive them out of the formal sector. So I think some kind of compromise where, yes, we focus, we foster, we enhance transparency, and therefore then also indirectly access to finance on the one hand, on the other hand, not making it too burdensome and then actually driving these firms actually deeper into formality. So I think there's a careful balance to be struck here. Thank you.
Thank you very much. Dr. Noel, last word.
I think Professor Beck and Kateri answered the question pretty nicely. The only thing, on the last question on monetary reporting, I totally agree with Professor Beck on this, is that, we need to define what we mean by monetary reporting and what shape that those monetary reporting should take. I think it's going to be, we have to look at the cost effectiveness of having monetary reporting, full monetary reporting, consistent with the accounting standard, etc. I know in some jurisdictions, especially the UK for the SME sector, they have a red book and they define what are the minimum requirements in terms of reporting and disclosure. Just not for it to be burdensome on the SMEs. And given the size of the firms that we are talking about in Trinidad, micro and small, having them to do full sets of a statement going to be very costly for the business, etc. And, again, burdensome. And we want to focus on the ease of doing business, right? And the ease of doing business has to be calibrated very carefully with the type of firms that we are talking about.
Thanks very much, Dr. Noel. So as we look to bring this session to a close, I think we had very spirited discussions this morning. I want to first start by saying thank you through David to the IDB again for the support. Thank you, Professor Beck, for the research oversight. It was very much welcome. Also want to thank the providers, the data providers, Planting Seeds and also NEDCO. If it wasn't for those agencies, we would not have those results to report to you today. So thanks very much to those agencies. Dr. Noel, thank you for your time this morning and for sharing your insights with us. And last but not least, I have to thank the internal research team, Kateri, also supported by Ailan Danisa and Natalie Thomas. Thank you all very much. It has been a labor, but a good labor, right, to reach to this point. And again, in keeping with Dr. Noel's view that we should do these surveys more often, is something that we will perhaps try to program into our research agenda in the years ahead. In terms of the next steps, the intention would be to publish these papers both across the central bank and possibly the IDB. So look out for those publications. If you're not already following the central bank or the IDB, do so that you can get alerts when new material pops up. So to our attendees, I see most of you have remained with us. We want to thank you for staying with us during the course of the morning. And again, feel free to reach out to us if you have any questions or comments. We want to thank you very much. So I'll bring this morning's proceedings to a close. Again, thanks and congratulations again to all the panelists and the presentations. Thank you.